All right. Okay, perfect. All right, so I'll be sharing my screen in a second. Can everybody hear me okay? Okay. All right. All right, wonderful. All right, everybody, welcome to our spring 2022 annual CPP Stock Pitch Challenge, or CPP SPC. It's always a awesome chance for you to, kind of flex some, junior fundamental ability analyzing stocks on a very high level. But again, it's geared towards kind of getting you into the discussion and, expanding your knowledge on how to fundamentally analyze equities. So we'll kick it off with a little kind of schedule events for SMIC as we close out the year. Next week, we have our portfolio optimization model to kind of end our SMIC ambassador series for the entire year. Then after that, we're doing elections. So again, stick around. If you've been a part of SMIC, your vote definitely counts. So we'll be doing that very soon. So expect something in the Slack channel. But for today, check this out. We have two finalist teams that made it through the first report round and into the presentation round. So we have MasterCard, which is team 5 with Andrew Cornejo and Julio Corral. They'll be going first. And then after that, it will be team 8 analyzing Pfizer with Sonika and Rebecca. And they'll be going second today. And we have a couple judges today, which will be myself, Victor Menezes, Joe Byrell. We also have Cam Massey and Michael Monroy as our 5 different judges. So each team will have 4 different judges, all unbiased opinions. You can't judge your own team. So with that, I think we're going to kick one of the teams out back into the waiting room now and begin on our first presentation. So let me do that now. By Sonika, by Rebecca. I'll move you there right now. Okay. Okay, let's see. How can I kick you there? Okay. Okay, she's going to get put in the waiting room, and so is Rebecca. And as I do that, you guys can, Andrew and Julio, go ahead and feel free to share your screen, and then we can get started, and I'll spotlight you too. And Naaman will be keeping time. He'll open up with, as soon as you start talking, basically, he's going to start your 10-minute timer, and he's also going to drop a 2-minute warning in the chat. And then he'll just cut you off at the end, and then we'll start with our Q&A after that. And the Q&A lasts 5 minutes, same thing. As soon as the first question starts, and be pretty brief with your answers. We're going to try to, not stump you too hard on the questions, because not, we don't have too much time to get really deep in the weeds. But whenever you're ready, we'll kick it off to you. And Naaman, go ahead and start the timer.
All right. Hello, I am Julio.
I'm Andrew.
We are Team 5, and we will be presenting our recommendation on MasterCard with a target price of $181, representing a 52% potential downside as of April 22nd.
We issue a sell recommendation on account of the stock price being overvalued, the company's lack of diversification, and an alarming amount of debt to equity. Now we will explain these 3 investment theses in detail.
So MasterCard has not lost market share in the payment industry, but they have not gained as much market share as other relatively new entrants, such as Block and PayPal. The payment industry has remained unchanged for decades, but it is undergoing tremendous growth in technology in recent years. MasterCard's price to book, price to earnings to growth is higher than the payments industry average. MasterCard has a 190% debt to equity ratio, which is drastically higher than the other companies in the industry.
MasterCard's revenue streams are composed of transaction and processing fees, domestic assessments, other and cross-border fees. MasterCard's archaic payment model is called the four-party payment system and has been detrimental to merchants. MasterCard does not take on any financial risk regarding credit, issuing cards, settling payments, or acquiring the payment for the merchant's disposition, but they do take a hefty cut from merchants nonetheless.
While MasterCard enjoyed a duopoly with Visa, they had an attractive debt to equity ratio, but that no longer is the case. Right here, you can see the correlation between the two. When Block went public,
in 2015,
right? Yeah, 2015. You could see the slowing in the dividend growth, and they also started acquiring debt around that time.
We've given MasterCard a 4 out of 10 ESG rating. A massive problem we see with MasterCard is that they have no real intentions on becoming an environmentally friendly company. They have a goal to become carbon neutral by 2050, which we found from their annual sustainability report. But some of the top polluters in the world, like Pepsi and Coca-Cola, have similar goals. This shows us that MasterCard is underinvesting in clean energy and much more focused on short-term business, which they are already falling behind in. Executive compensation charts were removed from annual reports and sent out in a proxy statement separately. When information is being buried or hidden, it shows that there are some not so popular decisions being made. Paying a lot for executives that execute well is not a negative by any means, but not being able to disclose the information properly and defend it is something we don't like to see in a business.
Our valuation is a 50-50 weighted average of our dividend discount model and relative valuation. In our DDM, we use a 3-stage growth rate of 18% growth, 10% transitioning, and 2% into perpetuity. For our relative valuation, we used the median price to earnings because we wanted to include the outliers without skewing our data, and the valuation recognizes that that MasterCard has a price above its peers. Our final valuation comes out at $181, which reaffirms our sell recommendation and indicates MasterCard's overvaluation.
Regulation here in the US has increased along with the cost of servicing regulatory standards. The industry is competing for talent in the fintech sector, so while wages keep increasing, it's been difficult to acquire new talent. China has Union Pay, India has RuPay, and combined they hold almost half of the world's population. Nations used to invite MasterCard and Visa to provide a payment system in the past because it secured tax revenue for these nations. When Crimea was annexed by Russia, MasterCard and Visa were asked to pull out from Russia, as they were asked to do so again recently, putting other nations on alert. Having a foreign company storing and using citizens' information has been deemed a national security risk as well. Some countries are undermining MasterCard's ability to leverage data it acquires and are obligating them to store the data within the country's jurisdiction. MasterCard states in its 2021 10K that it outsources most of the technology it uses, which can explain some of the debt. Real-time payments are on the rise in some nations like China and are prevailing over credit card payments. Why would developing nations who are moving away from cash use the old infrastructure? MasterCard has benefited from entrance of competitors like PayPal and Square because the new entrants are using MasterCard's system to link institutional banks to their platform. MasterCard is sharing technology and its system with technology-savvy companies, which could push MasterCard out of the comfortable position of collecting fees while undertaking a minimal financial risk.
By our analysis, we have found that the company is overvalued, lacking development in in-house technology, which is causing a debt expansion. When companies feel the end is near, they begin to acquire rather than develop technology, which results a race to the bottom. Ultimately, every risk to this company will resonate in investors' minds when they no longer have what they paid for, which is growth. Growth in revenue and earnings were reduced in 2008, 2020, cutting the stock price in half, which we feel is likely to happen again. Thank you for having us, and thank you, Joy and Michael.
Now we're open for any questions.
Right on. All right. So Naaman, we can stop the presentation timer. And then as soon as one of the judges, any of the judges, feel free to, I guess, raise your hand, and then we can moderate like that. Once that first question is asked, then we can go forward. But I guess really quickly, good job, guys. It looks great. So I saw Cam's hand first. So Naaman, go ahead and start the timer as soon as Cam goes and asks this question.
Thanks, guys. Good presentation. My question was sort of for one of your first slides in the industry and competitive positioning space. So you shared the market share for, basically a couple of different competitors. And I'm wondering, how has that changed for MasterCard over time? Like, have they been losing market share? Have they been gaining it? And what do you see the company's competitive advantage being? And how does that relate to where their market share is at now?
Okay, I could take that one. So they haven't been losing market share. They've actually been growing. The entrance of Square and PayPal have actually benefited MasterCard because they are already embedded in the system, and they're basically a transition between institutional banks with these new platforms, right, like Square and PayPal. But they're not growing as quickly as Square and PayPal, and these companies are using real-time payments, and we fear that over time, I'm not saying within the next 10 years, but over time, credit cards might become obsolete, and MasterCard continues to use their four-party payment system, and it's lacking technology. It's buying it, it's acquiring companies, and it's doing some moves that a dying company would probably do. But it's going to be around for the next 20 years, I think, and continue to grow.
Cool. And I think my follow-up to that is, has management addressed any of those issues, or have they sort of given like some insight on how they plan to address the technology lack maybe that they have? So I was trying to correlate their acquisitions with their debt. Their debt is alarming. They're not taking any financial risk, and they're acquiring a lot of companies. And they state on their 10K that they do not develop their technology. They basically pay for everything. And as you know, that might get expensive. It's also expensive to do research and development, but if you don't know what you have to buy everything, you end up probably paying a premium. Okay. I guess that'll be my last question then is, what have they been using their debt for, if not for trying to expand the business? Do you know why it's that high?
So they strategically pulled out long-term debt in 2020, which I thought was smart. And then they lowered their short-term debt, which I thought was smart as well. After they've been acquiring a lot of companies. 2021, I was gonna list them all, but I didn't have time. Some they have acquired just completely, and some they have minority and partnerships with, and that's so they basically have a good amount of cash, and then they've been acquiring companies.
But we'd like to add that if the economy were to slow down and things get rough, it's not going to be beneficial to have all this debt on their balance sheet.
Okay, thanks, guys.
Okay, we'll switch over to Joe.
Hey, can you hear me all right?
Yeah.
Yes, sir.
Great presentation, guys. To start off with the questions that I have, could you go through the discount rate you used in your valuation?
So we use a cost of equity of 8.25%.
Okay. And then could you expand on how you accounted for the risk of the debt? in your model?
The risk of the debt. Oh, in our model. Okay, so we did a dividend discount model and relative valuation. So we
Right.
took the average of them, of those two.
And that'll be the net income in the dividend discount model. I am trying to understand exactly why the deviation between those two models, because the valuation for dividend discount was surprisingly low.
Yeah,
Yeah.
it was.
So their dividend growth has actually been declining.
Right. And did management offer any guidance on that? Is it maybe COVID related, or was there a justification in the future that they would go on increasing dividends? Because MasterCard's not a young company. They're pretty
60
late stage.
years old.
Yeah, well, they didn't cut the dividend, but they just slowed the
Slowing.
growth so that they could focus more on growing the business itself. That was the guidance that we found.
Okay.
2020, they took a downturn. I mean, they did what was correct in my eyes. Strategically, they lowered down their dividend payment.
Gotcha. All right. Thank you.
Let's see if we have one more time for one quick question from Victor.
Yeah, I'll make it kind of brief. One, I really enjoyed your presentation. You guys did really well. It blew my expectations. My question is mainly revolving around your last slide that you said that they race to acquire rather than race to develop. And I was just curious about that, because typically if they're not really experts necessarily in developing technology, maybe it would make more sense for them to acquire companies who are operating in these fields. So I was just wondering, like, since they've had past acquisitions, have they historically helped the company at all? Have you seen any benefits from them, or have you seen negative effects from past acquisitions, which makes you so negative towards the recent acquisitions?
Yeah, so we are, we're a little shaken with them acquiring, because in that business, you're a middleman. So when you're a middleman and you're sharing your technology with everybody else, which you have to because of regulation, because of transparency, because of all these things you have to share with your partners. When you have to acquire technology and everybody knows your technology, it puts you in a position to get taken out from being the middleman. They don't take on any financial risk, and they're, merchants have been, hesitant to do business with them. I don't know if you've ever been to a liquor store, like, we don't take credit cards. They gouge, an arm and a leg, an eye. So we feel that, they should be developing technology to keep up with Square and, Blocker, PayPal. If they want to remain in business, they have the cash to do it. They're just in a comfortable position. And you're right, it's difficult to be such a large company that is accustomed to playing this part and changing from, one day to the next. So that's why we call it a sell. You don't want to hold that company while, interest rates keep going up and their growth goes down.
Okay, perfect. I guess I'll try to squeeze one last time, and we have a couple seconds left. But if you can name one of the biggest pain points in MasterCard, what would it be?
Pain points?
Yeah, the biggest driver affecting a sell valuation.
Definitely that
Inflation.
they're over leveraged, right?
Yeah, that inflation, historically 2020, that little mini recession, and 2008, their growth, turned negative. They were still doing really good, but the growth went negative and the price was cut in half. Why would you want to hold that, especially when it's a different story? We're not in 2008. There's new entrants, there's new companies out there that'll make you think twice about your investment.
Okay, perfect. All right. So that wraps up our questions. And I think we'll tell you guys to stop sharing your screen, and we appreciate, of course, it was a great presentation. And definitely stick around for the end and our final deliberation. Okay. So next up, I'll unspotlight you two, and then I'll be letting in our next batch. Okay. Okay. Perfect. Hi, Sonica. Hi, Rebecca. I'm going to spotlight you two, and then go ahead while I do that, go ahead and share your screen. Okay.
Sounds good.
Okay, perfect.
Let me make sure all my notifications are off. Hold on. Do we just start whenever, or is Naman gonna?
As soon as you start talking, Naman's going to press that 10-minute timer. Okay. All right. Feel free to go when you're ready.
Okay, Rebecca, are you ready?
I can't say no. So yeah.
Okay. So PFE FIFO FUM, our giant star shining through the new normal. This is what we think about when we think about Pfizer Incorporated. Hi, my name is Sonica Gavankar.
My name is Rebecca King.
And we are Team 8, and today we'll be discussing our issuance to buy Pfizer Incorporated based on a target price of $59.90, which implies a potential upside of 16.2% from its closing price of $51.57 as of April 1st, 2022. Hold on. Okay, perfect. We are recommending a buy based on the following reasons. Number one being that subjectively conservative estimates in our valuation still yield high upside potential. We originally extrapolated data from Bloomberg and then would readjust them based on what we believe are the current conditions of the market. With COVID being a huge factor, we wanted to be wary of the uncertainty that may come when the pandemic comes to an end. Secondly, it's the increased demand in COVID vaccines and their COVID pill Paxlovid. The FDA recently approved the second dosage for children and the elderly, and with the approval of the pill, many countries have already started to pre-order them to distribute to their citizens. Lastly, high R&D but low debt to equity. After looking at their balance sheets, financial analysis, and everything, financial statements, we've seen that they're including their high increases in revenue. There's also something called the Operation Warp Speed, in which the Trump administration granted Pfizer $2 billion for research and development of a COVID-19 vaccine. Normally, we all know that high R&D leads to high debt to equity ratios, but with these two buffers, the company experienced low debt to equity in these past 2 years. And I'll pass it on to Rebecca, who's going to talk about our industry outlook.
Thank you, Sonica. According to Ibis World, the brand name pharmaceutical manufacturing industry from 2018 to 2020, as you can see on the very leftmost graph, in 2020, we have seen a major increase due to COVID, and we expect it to plateau and normalize within the coming years. We used Amgen, AbbVie, Merck, Eli Lilly Co., Bristol Myers Squibb, Johnson & Johnson, and Viatris to compare Pfizer with the industry median. Pfizer thrived against these biopharmaceutical companies, keeping their revenues high and their debt to equity low. In 2020 to 2021, Pfizer received a tremendous amount of orders for their COVID vaccines, causing them to rise above the industry median. The combination of sales and operational warp speed helped cushion the high debt that they had, leading to a low debt to equity ratio. With these factors, we're confident that Pfizer is one of the top companies in the industry. Pfizer was founded in 1849 in New York. It's a global research-based company that operates as a single operating segment in the biopharmaceutical industry. The company offers medicines, vaccines, medical devices, and consumer healthcare products for oncology, inflammation, cardiovascular, and other therapeutic areas worldwide. Above, we have broken down the revenue streams in which we see a huge increase in vaccine sales or vaccine revenues from 2020 to 2021, which is almost double. And I'll pass it on to Sonica for financial analysis.
So Pfizer witnessed its worst year in 2019 as several intellectual property rights contracts and patent protections expired. The company quickly recovered in 2020 and 2021, however, as the introduction of COVID-19 occurred and the rush to find a solution started. Company revenue for the 2021 fiscal year increased by almost 95%, jumping from 41.7 billion to 81.3 billion in revenue. Revenue is still expected to grow in 2022 as the increased demand in vaccines remain prevalent and accounts for 45% of all 2021 sales. However, we believe that revenue growth will start to slow down going forward as there will be less of a need for preventative actions as more of the population gets vaccinated. The continued recommendation for additional doses combined with the US government having already bought 20 million Paxlovid courses leads us to the conclusion that the increase in EPS is due to COVID-19 and just, people trying to prepare for that next wave. And now I'll pass it off to Rebecca.
Pfizer's environmental initiative efforts were recognized by a nonprofit organization that assists corporations managing their environmental impact on the world. They recognized Pfizer as the supplier engagement leader for the fourth consecutive year for their reduction in environmental risk in their supply chain. And moving on to social, Pfizer aims to increase its medicines and vaccines against marginalized groups through partnerships and programs. They promote health and well-being by ensuring equitable access to medications and vaccinations. And then moving on to governance, Pfizer has 4 women out of the 12 board of directors, or 4 women in their 12 board of directors, I should say. At the end of 2020, Pfizer reported that women at the VP level and above made up about 38%. And then the next year, it increased to 41%. Pfizer also reported 21% of their employees at the VP level and above being US minorities at the end of 2020. And then I'll pass it on to Sonika for the valuation.
So we equally weighted the results we received from our relative valuation, our discount cash flow, and our dividend discount models, in which we got a $59.90 target price with a 16.2% upside. In the next few slides, we will go over each model in depth, starting with relative valuation. So our RV includes Eli Lilly, Merck, Bristol Myers, J&J, Viatris, AbbVie, and Amgen. When using the Bloomberg's RV function, we were given an extensive list of firms that we could compare to Pfizer, but we are only left with 7 as we wanted to ensure our list only included companies that are very similar to Pfizer. Some examples of companies that we took out were companies that focus on animal and vet sciences or pharmaceuticals, as well as companies that focused on cannabis-based medications. Considering Pfizer's historicals to industry peers, which we derived using Bloomberg GIG's peer set, we believe that the firm has an 18% upside. Moving on to our DCF and our DDM model with first up DCF on the left-hand side. Our DCF utilized an average of negative 1.39% growth rate over the next 5 years, and we assigned a 2% terminal value to cash flows. In regards to the cost of capital, we issued a weighted average cost of capital of 7.5%, which led us to an estimate of 80% upside for this stock. With our DDM model, we considered Pfizer's historicals on dividends, used a dividend growth rate of 2.8% and a cost of equity of 7.5%, which in turn gave us a potential downside of 33.84%. And now I'll pass it on to Rebecca to wrap up this presentation.
In terms of industry-specific risk, we see that Pfizer is subject to balancing commercial pricing and accessibility for their prices. This includes laws and regulations governing their operations of their biopharmaceutical companies, such as the approval, the manufacturing, and the marketing of these products, as well as health information privacy. They want to be as competitive as possible, but they need to implement their ESG initiatives in order to, provide their equitable access. The next risk is inflation and currency rate fluctuations. Since they're working with governments and organizations worldwide, fluctuations in currency relative to the US dollar can cause a barrier to max out their revenue potential. Lastly, government regulation and price restraints causes a strain to the company. And moving on to the business-specific risks, we have generic drugs and biosimilars to consider. After losing patent protections in 2019, Pfizer saw multiple competing generic drugs and biosimilars take to the market. An example would be Lyrica, a medication to treat nerve and muscle damage. It was slowly wiped off of the map as a result of this, which is also an example of Our second, business-specific risk, the loss of patent protections and internet intellectual property rights. Lastly, the product pipeline has 89 discovery projects, with only a fraction of them being ready for or ready to go, as they have an increased focus in COVID-related research and development. Sonic and I recommend a buy for the Pfizer stock with a target price of $59.90 and a potential upside of 16.2%.
That's our presentation. Thank you.
Right on. All right. So you made it in time, and it looks like we have a question from a judge. And Naaman, go ahead and hit that timer, and we'll stretch it. Yeah, we stretched the last one to 6 minutes, so we're stretching yours to 6 minutes as well. So let's get into it. Yeah.
Quick question. Do you want us to share our screen to show the appendix, or?
Sure, if that'll help answer any of the questions, sure. All right,
Okay.
we'll kick it off with Michael. Go for it.
You guys, that was an awesome presentation. I really liked it. I just had a curious question about the valuation models. I was wondering what went into the decision to make the DDM model a 2.8% growth rate and the DCF model a 2% growth rate.
So for the DDM model, originally we were looking at Bloomberg just to get an idea of what it could be, and they were doing about 3%. And we just believe that although they were showing, how do I say this? They were showing, they were showing up in their dividends, like they were consecutive in dividend growth and also in giving out dividends. We just believe that 3% was a bit too much, but we also didn't want to go too down below, like to 2%. So we stuck to around 2.8 because we believe that was around the better, it was better for this model. And then for the 2%, I believe we just wanted to stay a little bit more conservative, because we do believe that, with COVID, it's going to go down soon, and we wanted to keep that into consideration with the next few years in growth. I hope that answered your question.
Oh yeah, definitely. I just also had a follow-up. For the growth rate between years 1 through 5, it is a negative rate. So I was wondering, did that have any effect on your recommendation at all?
Originally we were both very concerned about that, but then we realized that we did that negative growth rate based on CAGR. So we estimated what we think based on what we've seen in Bloomberg in some of the places that we've seen, we've realized that revenue is slowly starting to go down, and that's because it's getting normalized. Just as other companies are starting to see an increase and then a huge decrease, it's going to be the same thing in this situation, because COVID is slowly going to go down. So although we were alarmed by a negative growth rate, we believe that it's just the company normalizing in revenues. It's not something to completely worry about.
Thank you, guys.
Okay, we'll pass it over to Joe.
Hey, great job on the presentation. It really shows the amount of work you've put into this is very great. But to get right into it, I have a question about your financial analysis. So if you could go over to that slide, specifically on both top line and bottom line growth, you're showing 2022 estimates, EPS growing 75%. That's incredible. Could you go into a bit of detail as to why you're projecting such an increase?
Rebecca, do you want to go into that, or?
That's a great question, Joe. I don't remember it off of the top of my head, but it was in our report. So I will have to get back to you on that one.
Okay, thank you.
I could give a little base on that. It's more so just because these are all Bloomberg estimates, and based on how increasing, like we mentioned before, there is going to be still Pfizer selling, distributing vaccinations and the COVID pill. So we believe that there's still going to be the EPS growth of 74.7% because of just how prevalent COVID is currently, and that it's still going to take some time for it to wean down and become somewhat a thing of a past.
Right, but you're only showing an increase in revenue of 3% from 2021, so it shouldn't be driven by additional sales of vaccines or the treatment but rather an improvement in, I assume, costs between revenue and EPS. It's just interesting.
We'll get back to you on that one then. We have to do a little bit more research.
Okay, thank you.
Right on. So I have a question, and when I was listening on the risk segment, I'm worried about, you're saying, I hear a lot, okay, COVID's been more normalizing, so I'm worried about the 50% of the revenue derived from vaccines. What percentage does COVID vaccines make up of their vaccine segment in the company? And, how is that forecasted, obviously in that negative growth rate, but, is that kind of alarming for you? Is that a buy recommendation? If, people, vaccine hesitancy and all that, how do you guys kind of factor in, what percentage of COVID is a part of their vaccine segment?
I can take a stab at this question. We have in our appendix a graph of those, there we go, those that are vaccinated against COVID. On the left, we have the share of Pfizer. 70% of the people chose to get, vaccinated with Pfizer. And then on the right, we have the countries that are vaccinated. And your question is that
how does the COVID, you're showing great vaccination rates. You're showing everybody chooses Pfizer. What percentage of their vaccine segment is actually COVID related, right? Because that's 50% of the revenue comes from vaccines, right?
So it'll be about 45%, if I remember correctly.
Okay. And, your outlook on COVID is, kind of weak in 2022 and 2023, a little bit beyond for the next 5 years. That's why it's a negative growth rate.
Yes, we see it as it turning more into a flu-like thing where you have the option to get, your flu vaccine, but it's not necessary. And there are doses that you can get, such as the next dose for those that have just been approved, like the elderly and then the immunocompromised. But we see it as being more of a preventative care thing in the future.
Okay. All right. Sounds good. Judges, do you have any more questions for these? If we have any more questions, I know Cam or Victor Victor can't comment on this one, but if Cam, if you have any last kind of comments, then we'll wrap it up here.
We are out of time, by the way, just letting you
Okay,
know.
perfect.
Yeah.
All right.
I guess I'll throw in one question.
Sure. Were we at 5 minutes, Naaman, or 6 minutes?
It was actually 6 minutes and 30 seconds.
Okay.
Okay.
I think we'll hold off on the questions then.
Sorry,
Sure.
Cameron.
Okay. All right. Perfect. So if you can stop share your screen again, good job, Sonic and Rebecca. I'll take the spotlight off of you. Okay. So what we're going to do now, the judges are going to go out into a breakout room and we're going to have a little chit chat for 5 minutes. And the time being, there we go. I can assign. Let's see. Okay, perfect.
I already made some breakout rooms, so I made one for each team and the judges.
Perfect. All right, so we'll be back at 12:45 or so. So those of you hanging out in here, sit tight. We'll be back in 5 minutes sharp for our deliberation period. Sounds good?
Brian, woo with the crowd.
That's right. All right, sounds good. All right, we'll be back.
Now that the judges are gone, what did you guys think? I'm just kidding. I gotta go.
Wait, Michael, I thought you were a judge.
Yeah, me too. Oh, there we go.
Okay, I think Victor, we can close out our meeting rooms here.
Yeah, I closed them.
We have deliberated.
It's gonna give them 60 seconds to join
That's fine.
back.
That's enough time. Perfect. Okay. I'm just setting up the slides here, and then I'll share once I'm done. Okay. So judges, if you want to give some, brief feedback on behalf of both teams right now, now's the good time to do that.
We don't have team 8 quite back yet.
Okay.
I believe Julio's still in for team 5 as well.
Okay. I know we did say 5 minutes sharp, so we still do have a minute left. But I'm going to share my screen here. Three, two, one. Okay. All right, perfect. All right, welcome back, teams. Is everybody here? Is everybody back now? Okay. All right. So I think just some quick comments is as soon as we got in the room, we were both shocked on how well you guys presented. And I guess a little bit of comments from me too. We can quickly shift over some quick commentary from the judges. Both teams presented so calmly, and again, you did look at the stock for the past month and a half. So again, huge props on that, but I'm very impressed with how, I guess, eloquent you were with, going through your recommendation analysis. I know nerves might've been kicking in a little bit, but again, that's a great pat on the back to yourself too. And also, you guys had good team chemistry too. I can sense that too. So anyway, just good job on a personal level. Then I'll throw it over to some other judges before we have our final our final view here.
Yeah, I have some comments for the team because I actually really enjoyed this process, and I hope you enjoyed talking to your mentors and learning a little bit more about equity analysis. I think it showed in your work and the way you spoke about the companies you did, that you were prepared and that you were enjoying what you were doing. So I am proud of both teams. You guys did amazing. It blew all of our expectations away. Not that we had any, but it was just really impressive to see you guys perform and work.
Okay. Hey, Joe, Michael, Cam, any of you guys have any comments?
Yep. I think both of the teams really did well, and it was evident that there were some points in each of the presentations that were really excellent. I think MasterCard had a really good understanding of the business, and they defended themselves well in the Q&A. I was impressed by that. Pfizer showed a very impressive understanding of the industry, well above what a lot of the other students doing equity valuations could or should know. So props to both of you.
Okay. Anything from Cam or Michael? If not, yeah. Looks like you got something.
Yeah, I could just jump in and say, having gone through this, I know it's really tough to be able to put together a presentation like that and deliver. And I think everybody sort of did that. You guys gave really awesome presentations, and it was cool to see everybody get to, give their specific points. I think each team sort of had, like Joe said, their competitive advantages, and it was really interesting to see that. So good job there. I think that the details are key in everything. So, that really made it or braked it for a few different teams, but overall, awesome job. And I think you guys are really well prepared for sort of what Smith looks like moving past this. So I'm excited to see what you guys do past this.
Perfect. All right. Michael, anything? Give me something, man.
Everyone did well. I like what all the other judges talked about. Just going off that, great presentation, guys. I enjoyed both.
Okay. He's a simple guy. All right. So here we go. Little drum roll before we flick to the next slide. Let's do this. All right. You ready for this? Okay. All right. Your winner of the spring 2022 CPP SPC is Pfizer. And, we have the little scoring breakdown right here. So again, congratulations to you two ladies, Miss Sonica and Rebecca. And again, this is not indicative of anything about, oh, we hated MasterCard. No, you guys did an excellent job too. So don't take this as any kind of, poor score in any category. It's just, hey, your competition really, really went out of their way to make this thing really good. So anyway, we're going to deliver our scoring guides and comments over to you two. And also, as being awesome participants of the CPP SPC, SMIC will also be giving you a $25 Starbucks gift card or Amazon gift card of your choice, for, again, participating and doing such a great job in the competition. So again, congratulations, gentlemen, for that. But your winners are Sonica and Rebecca. So anyway, if anybody has any comments, questions, definitely congratulate them. You see the scoring breakdown here. These are weighted averages of all 4 judges, for each category. And again, this is just a summation of the averages from above. So there you go. There you have it. So again, congratulations to both the teams. Okay. All right. So we'll be in touch to get any compensation for this. And with that, I think we'll close out the meeting here. Again, thank you, Joe, for taking time out of your busy day to come help us out and be that awesome guest judge. And with that, thank you. Enjoy the rest of your Tuesday.